Let's get to the big picture of the financial market. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. When you look here at the sectors, we do have a bit of a massacre. Megatrends as well. It is still outperforming the S&P 500 70% from the 52-week lows. But there's been monster bear markets. As a matter of fact, it is difficult to find themes that are not in a bear market. Bicycling, not bear. Supercars, high-tech finance, but that one is 2% away from a bear market. Portable technology, 3% away from the big bear. Carbon credits, that is the most, the strongest ones. The strongest one. Freshwater demand, minus 17%. And then you have data centers. Looking at some of the other themes like biohacking, minus 64% away from the 52-week highs. Vegan food, minus 69%. These are vicious bear markets. So I thought that we should just look at some of these items. So let's look at, as an example, at vegan food. So let's just jump into Beyond Meat, just to sort of see what is happening. Okay, so let's do it like this, and then we just do bind. So here is Beyond Meat, weekly data points. So looking here at Beyond Meat, even though things are really bad, you could make the case that this might be a double bottom. So that's interesting. So even though things are looking really bad for Beyond Meat, maybe this is the low. At least this is not like a horrible time to at least consider some bullish opportunities here. But you do want to have stops. Double bottoms are interesting for Beyond Meat because if you look here and here, this is a double bottom, and that one definitively worked out pretty well. But yeah, purely hypothetical. Looking at the WT, the Total World Stock Market ETF, we are seeing maybe the early signs here of a rounding top. So a rounding top is a bearish pattern. When you look at the history of this ETF, you see that rounding tops, they have played themselves out before. Like here a rounding topish, here a rounding topish, here a rounding topish, and also here. And when a certain pattern is active in the now, and you see that it has played itself out in the past, then that increases the probability that it will play itself out again, because a lot of things in the market are self-reinforcing. So that's something to put on our radar. Let's look at the DX, the dollar index. So we will just run through different kinds of markets here, viewing it purely technically. So the thing is that, when I analyze something more deeply, I always want to look at as much data as possible. So I look at the charts, fundamentals, macros, seasonality, correlations, you name it. That is the best way to make a very informed decision. But if I were to do that for everything I look at in this video, then the video would become very long. I think that the most important thing, as far as analysis goes, it is actually a technical analysis. That is, at the end of the day, it is the thing I put highest. So that is why that is the focus in this video. But to be perfectly clear, I think you always should look at as much data as possible when making a decision that involves it either hitting buy or sell in an account. Okay. So looking at the dollar index, we certainly have seen this strong rally. We have now entered this zone that's previously been, massive. We have this massive cluster here of resistance levels. So I'm not surprised to see this a bit of a pullback, and this is just a massive volume shelf. Volume ceiling, okay, ceiling, and it is possible, of course, for dollars to break through, but it needs more energy to break through these resistance levels than it did during this rally phase, because this rally phase was more clean and easy sort of to do than what is going to happen, well, what the future holds for the dollar index. Yeah. Let's now jump into, let's look at China. So China, it has seen some more breakdown, but also the last 3 weeks the bulls have come in to buy the lows. You see here with the candlesticks, we went down much lower, but then we close higher. So this, it certainly seems like some very big participants in the market are viewing this as a buying opportunity. And I certainly think that if you have a long-term time horizon, talking, years, this is a very interesting time to consider a bullish position on China, on the FXI. The outlook long-term for China is very good. The price for the stock market is currently low, at least at a horizontal support level, so it is simply just interesting. But whenever you do anything in the market, you obviously want to use stops, because we have been pretty close to breaking through some very important horizontal levels here, and some have actually been damaged. And if too many of the support levels are damaged, then that could create some panic selling. So it's very important for the bulls to really get into action here in a more major way. And it could be that that is what we are seeing here with the last 3 candlesticks, which certainly are the kind of candlesticks that it doesn't terrify bears, but it certainly makes the bears tighten their stops. Like if I was short China now, I would definitively not like these candlesticks. They are a bit too aggressive. Okay. Then we will look at some, let's look at some commodities. So let's look at crude oil. Let's actually look at gasoline, because the gasoline price has been such a huge topic. So here is gasoline RBOB futures. Yeah, it's still up, a lot, like substantially from here, the lows during the lockdown. What is potentially interesting here is that we do have something that looks like a bit of a, it's not a clear head and shoulders pattern, but it is head and shoulder-ish. So if we do see some weakness here, ideally that the weakness comes before we get above this level of the left shoulder, then we would have, a head and shoulders pattern. So that is something that could be beneficial for those who want cheaper gas at, the pump. Then we go to natural gas, another, commodity that's certainly been in the news. So yeah, I turned bearish on natural gas. I thought that, it was very, very high, and I looked at some historical patterns, and we definitively have seen a very substantial sell-off here in natural gas futures. We are now dancing around this green 50-week moving average, and it certainly seems like the bulls are buying it. Not with a lot of confidence. I mean, they were way more confident here. And you also have the phenomenon of bears closing their shorts, and in order to close a short, you have to buy it. So yeah, that's also likely helping the bulls, but still we are very far away from the highs we made back here. So it goes to show you that there is certainly alpha in looking at the past history of a security. What is more messy when it comes to doing these historical studies, that's when you have an anomaly. So let's take a stock like Home Depot. So when you do an historical study of Home Depot and you look at RSI and MACD as an example, so let's do it like this. So now we have weekly data points, and we go all the way back here to 1982. So we recently set levels on the MACD that we have never ever seen before. The levels on the RSI to the upside were obscenely high, like setting levels that you can't assume will happen. So from a purely like logical standpoint, using the past to make predictions about the future, it certainly has made a lot of sense to consider short positions on Home Depot. So even though it has gone higher, you cannot assume that you couldn't at the time of analysis assume that it would happen, because beating the market is difficult as is. If you are going to create a trading strategy where you assume that a statistically improbable event will happen, then you put the odds extremely against you. So to be clear, the people who have had the best tactic when it comes to Home Depot recently with these extreme technical readings, that's those who have considered short positions. Obviously, they should always use stops. But I think what is extremely dangerous with stocks like Home Depot and let's look at Oracle. Oracle is also one of those stocks that have done things they have never done before. So if you look here at big picture study, the last time we had this kind of MACD was back here during the dot-com bubble. Same with our RSI. We had readings that were extreme. So it would be very unreasonable to assume that an event that only happened previously back here during the dot-com bubble would happen here. That is assuming and betting on something that has a statistical low probability. So when you are here, so analysts that are like, let's say here, who then look at the past and be like, well, I think it's interesting to consider short positions on Oracle. That makes sense. It does not make sense to assume this. Obviously, you have to respect that this could happen, that you can get an anomaly to the upside, which we certainly did get. So let's measure it. Let's do some analysis here. So let's just compare how much it went up. So this is the MACD we got there. So if you take it from this to this high, that is a 77% rally. That is obviously very, very, very substantial. That is definitively, a clear example of how, even though logic past logic, a thesis based on the history of a security corroborates certain trade, you always have to use stops. And the great danger with all of these anomalies is that there's a massive contingent now of investors that have a very distorted perspective on the market. Like, they will assume that these things just happen, that things just go to the moon. And I think that the massive sell-offs we have seen in all kinds of megatrends, that is because of that. You have so many new participants in the market that are so convinced that things would just go up forever, that they don't believe in that a sell-off is serious. And I think that's how you can get these situations that we have with, let's take Virgin Galactic. So even though we have had all kinds of support levels that could work out, as you see, they have failed. And while obviously we do not know exactly who has been selling, I'm pretty sure many of them are people that were a part of these big rallies. Because when you are a part of a rally like this, 252%, and then you think that it's just getting started, that we are going to go up, thousands of percent, then you put yourself mentally in a psychological space where it's all like extreme numbers. So when you have these pullbacks, you are still in like extreme numbers mode. So you don't take the pullback seriously until you have to, until the numbers in your account literally become red. And then you have people who could have closed out at 255% gain. They then instead, just in panic and desperation, just close out with the minus 29% loss as an example. And that is something to consider with your own trading as well, is that the biggest losses many people have in their accounts, it's not the red numbers. It's the green numbers, because the red number, the biggest loss you can have on like a stock you go long, bullish, is 99.999%. But you can lose more from a gain. So if you take something like this, so here is a gain of 254%. But if you did not close it, and you decided to close it when you had red numbers, you waited because you saw green numbers in your account, so you sort of lost perspective, and you closed here with minus 23%, then the loss you have is not simply minus 23%. It actually is a lot worse. A lot worse. Because you had the potentiality to close out a 254% gain. Beyond that, you also lost 23%. So you could argue that you lost 277%. And this is not, the worst example either. I have, even myself been through situations, especially when you get into like the options market, where you have some out of the money options that go up, big, and you can have like thousands of % gain. But if you don't close it, then when you have, that nice gain, and you instead end up closing a gain of a couple 100%, that means that you could literally have lost over 1,000%. So that is something to think very carefully about. Because the big problem with the vast majority of trading accounts, brokerage platforms, is that they only show you the percentage change from when you from when you entered a position. What I think they should do is to show you the percentage change from the lowest point since you bought, but also from the highest point. I think that would be extremely beneficial to a lot of people, because it really puts things in perspective and would make them way better at position management. Because that is huge, and some of the biggest losses I have ever faced in the market, it's not losses. It's not when I buy something like Virgin Galactic at what I think is the support level, and then it goes against me, and then I'm stopped out and I have a loss. Or when I buy something like Curiosity Stream, thinking I am getting a support level, then I put my stop in and I'm stopped out because it goes against me and I have a stop and I have a red number in my account. But even getting something like a 10% loss, it is annoying, and it feels like a big sting. But what is so much worse, that is when you have, so let's illustrate it with this stock as well. Let's say that you buy here and you have 172% gain. If you didn't use stops and you instead, in just desperation, closed here with a minus 11% loss, and you let all of these gains go to waste, that's a huge loss. That's way worse than buying a stock and losing right out of the gate. And this is such a common thing. It's a huge, huge thing. It's a problem for a lot of people. And this is why I've become really fascinated with position management as of late. I've always been into position management and sort of taken it for granted. But I see that there's so many people who are just, they don't think of it. And the vast majority, as I said, of brokerage platforms, they are designed to help you. Their business model for a long time has been transactions. They make money on commissions. So the more you buy and the more different stuff you buy, the more money they make. And because of that, their platforms are designed around that. And that is something that is very apparent in how they are designed. But given that many platforms now have, these zero commission structures, I think that they need to be redesigned. So sure, it is of course important to make it easy for people to do all kinds of analysis, but what's even more important is to make it easier to understand how your positions react. Position management. And that involves implementing tools that are simply just not common at all currently. So let's illustrate something else. Another important thing that many people are not aware of. So here I have this illustrative case studies. So this shows you how much something needs to rally in order to recoup a loss. So let's take something like Virgin Galactic as an example. So Virgin Galactic has now fallen from a high of 62.80 to a low of 12.05. Hence, the percentage loss is minus 81%. In order to fully recoup that loss, it needs to rally 421% from the current price. So this really shows you the magic of percentages, and also why there's so much alpha that can be gained from buying low and selling high. If you look at CRISPR Therapeutics, it has gone through a loss of minus 69%, and just to recoup that loss, it needs to rally 219% from the current price. So this is why it is super, super important to buy low, sell high, and also to have stops in place, because it doesn't take that much until losses become very hard to recover. So here is a calculator I have made. When will I recoup my loss calculator? So how much does my portfolio need to rally to recoup an 86% loss? So in this case, that would be from low to high, it needs to rally 614% just to break even. That is obviously a lot. So let me show you, how these percentages work. And this is why you need to be very strict about your stop levels. So always have stops when you put on any position. So if you have a 3% loss from low to high, you only need a 3.09% rally for your position to break even. So a 3% stop, not a big issue. If we go to 9%, okay, now it needs to rally approaching 10% just to break even. But still, it's something that is recoverable. Then we get 20%. Now we need a 25% rally. So you see that there's a 5% difference here. 20% loss, but it needs to. Then we go to 40%. And now all of a sudden it starts to get serious. So if you have a 40% loss, so if you use 40% as a stop level, which is extremely a wide stop level, it needs to rally 67% now. But it gets worse. 50%, all of a sudden you need a 100% rally. 65% loss, 185, and if you have let's say, okay, let's not go that extreme, 80%, 400% rally, just to break even. And see how quickly the percentages become super dramatic. 85, 567, 90, 900%, and then take 99% here. So if you have a 99% loss on a position, from low to high, it needs to rally 9,900% just to break even. The big problem is that this how percentages work. This is not just not part of the majority of trading platforms out there. So yeah, this is definitively something that is super, super important. I know that this is a bit of a digression, but it is actually way more important than much of the other stuff that I publish. The problem is that YouTube and the other video platforms, they do punish, frankly, these kinds of videos because they calculate, how many minutes of a video are viewed by the average viewer, and so it's risky to create like long form content. Because of that, I have put it behind this platform called Teachable, and I will reopen this subscription pretty soon. And then on that platform, I will be able to go really into detail on a lot of super important stuff that is will be greatly beneficial to those of you who want to really get that deeper understanding of the market.